Dear students, welcome to this introductory lesson on economics, a fascinating and fundamental discipline for understanding the world around us. Today, we will lay the foundation for your economic knowledge by exploring key concepts and the dynamics that govern our societies. Economics is essentially the study of how societies address the challenge of scarcity. It analyzes how individuals and communities use limited resources to produce necessary goods and services. The discipline also examines how these goods and services are then distributed among members of society. Its field of investigation is vast, ranging from everyday consumer decisions to global economic policies. It is a social science that helps us make sense of the complex interactions between supply and demand, production and distribution. The primary goal of this field is to help us understand the profound influence that economic decisions have on social well being. We want to understand how these choices affect the quality of life, prosperity, and stability of nations. Another crucial goal is to optimize the allocation of available resources. It's about finding the most efficient and equitable way to use what we have in order to maximize value and satisfy the greatest number of needs. To begin exploring political economy, we must focus on three central elements: wants, goods, and services. These are the pillars on which all economic analysis is based. Human needs are the starting point of all economic activity. They are by their nature limitless and dynamic, constantly evolving with society and progress. Their satisfaction is the engine that drives individuals and organizations to produce and exchange. We can categorize needs into two main types. Primary needs are those essential for survival and physical well being, such as food, water, safe shelter, and clothing. Failure to satisfy these needs has serious consequences for an individual's life. Then there are secondary needs, or NRJ, which emerge once the primary ones have been satisfied. These include the desire for entertainment, advanced education, travel, or luxury goods. Their satisfaction improves the quality of life, but is not essential for survival. To satisfy these needs, the economy uses goods and services. Goods are material, tangible objects that can be produced, exchanged, and consumed. A car, a book, or a plate of pasta are concrete examples of goods that satisfy different types of needs. Services, on the other hand, are intangible assets that provide utility. A college lecture, legal advice, or a haircut are services. They cannot be stored or touched, but they satisfy specific needs or desires. The defining characteristic of the resources at our disposal is scarcity. Productive resources, such as human labor, financial and physical capital, raw materials, and land, are limited. This scarcity is an inescapable reality for every society. Scarcity means we can't produce everything we want. We're forced to make choices, to set priorities on how to allocate our resources. This is the heart of the fundamental economic problem. The primary focus of economics is precisely the efficient allocation of these scarce resources. The discipline seeks to understand how to optimize the use of what we have to maximize the satisfaction of needs and collective well being. Every economic decision, from individual spending to government policy, is influenced by this principle of scarcity. Every society organizes the production and distribution of goods and services through its own economic system. These systems are based on the interactions of several key players, each with specific roles and functions. Understanding these players is essential to deciphering how the economy works. Families represent the fundamental consuming unit within the economic system. They are individuals and groups of people who demand goods and services to satisfy their needs and desires. Their spending fuels the market and directs production. Not only do they consume, but households are also the main suppliers of production factors. They offer their labor to businesses and the state in exchange for income. Furthermore, they provide their capital in the form of savings or investments, contributing to economic growth. Actually, businesses are units of production. Their primary purpose is to transform resources into goods and services desired by households and other stakeholders. They organize work, use machinery, and use raw materials to create value. Businesses play a crucial role in the economy, generating employment and innovation. They purchase factors of production from households and remunerate the capital employed. Their efficiency and ability to respond to market needs are vital to prosperity. The state plays a multifunctional role in the economy. It intervenes through taxation, collecting resources from citizens and businesses. These resources are then used to finance public spending, which includes essential services and infrastructure. Another key function of the state is regulation. It imposes laws and regulations to ensure fair markets and the protection of workers and consumers. It establishes the rules of the economic game. The state also provides numerous public services, such as education, healthcare, security, and transportation infrastructure. These services are often offered free of charge or at discounted prices because they are considered essential to collective well being. Finally, the state seeks to correct market inefficiencies by intervening when market mechanisms fail to achieve optimal results. This can occur in the presence of externalities or public goods. Finally, we have the rest of the world, an increasingly important player in a globalized economy. This sector encompasses all the economic relationships a country maintains with other states. Modern economies are globally interconnected. These relationships manifest themselves through the import and export of goods and services. A country purchases products from abroad and sells its own products to other countries, creating international trade flows. Foreign investment, both inbound and outbound, is also crucial. Companies can invest in other countries and vice versa, creating opportunities for growth and technology transfer. Finally, there are financial flows, Gosi, which include capital movements, NDEs, loans, and international payments. These flows allow for the financing of global trade and investment. To fully understand how all these actors interact, we use a simplified yet powerful model, the economic circuit. It schematically represents how the economy works. This model illustrates the continuous flows of goods, services, and money that occur between households, businesses, and the government. The economic circuit allows us to visualize the interdependencies and links between different subjects. There are two fundamental types of flows that characterize this model: real flows and monetary flows. Real flows involve the physical exchange of goods, services, and factors of production. Imagine the concrete movement of what is produced and what is used to produce it. Families, for example, offer their labor, capital, and land to businesses. These are the essential production factors that businesses use for their operations. In exchange, businesses produce goods and services which are then offered to households. This is a real flow of finished products from producer to consumer. Monetary flows are the financial counterpart of real flows. They represent the monetary payments that occur for the exchange of goods, services, and factors of production. It is the money that circulates in every transaction. For example, firms pay wages, salaries, rents, and interest to households for the use of their factors of production. This is the income that households earn. In turn, households pay firms for the purchase of goods and services. This consumer spending represents revenue for businesses and closes the loop of cash flow. The state intervenes in both flows. It collects taxes from households and businesses, monetary inflow, and provides public services or makes transfers, real or monetary outflow. The rest of the world participates through imports and exports, with incoming outgoing flows of goods and flows of money to pay for them. The economic circuit is a simplified model, but it is fundamentally important. It provides a clear and structured view of the interactions between economic actors. Through this model, we can begin to assess the overall health of an economy. By examining the speed and magnitude of flows, we can deduce valuable information about its performance. It also allows us to identify any imbalances or inefficiencies within the system. For example, a reduction in spending flows could indicate an economic contraction. Finally, and perhaps most crucially, the economic cycle helps us predict the consequences of economic policies. And by changing one variable, such as a tax or government spending, we can anticipate the ripple effects on all other actors and flows. It is the basic conceptual tool for any in depth economic analysis.